Today, I want to talk about a topic that has been on everyone's minds lately, the economic situation in the USA. As we all know, the country is facing some serious economic danger, and it's important that we understand what's going on and what we can do to help. We are going to be looking at every component involving the recession story and also explain what might happen when the recession comes. So, why don't you take out your pen and jot down a few things? Let's go. In a recent interview, Donald Trump slammed Joe Biden's economy, blaming the president for driving the U.S. into a recession. The former president addressed the stock market, gas prices, and oil policies in a 15-minute phone segment that aired on Newsmax's Eric Balling the Balance, where he said Biden and the Democrats have destroyed the economy. We had the greatest economy in the history of the world, especially just prior to COVID, or the China virus coming in. We had the greatest ever, Trump told Balling. I actually had the stock market higher than it was even before COVID. And then they destroyed it. Trump said the economy coasted for a year and a half, but is now in a lot of trouble. Our country has never been like this, he said. And we're in serious danger with what's going on in Ukraine and with Russia. You can end up with a world war the way they're handling it. Crazy. What they're doing is crazy. I think we're in a recession, Trump told Balling. This is not something that's going to happen in 2 years. We're in a recession, and you're driving people into a recession. And people aren't working and it's not a good time. Why do many economists foresee a recession? They expect the Fed's aggressive rate hikes and high inflation to overwhelm consumers and businesses, forcing them to slow their spending and investment. Businesses will likely also have to cut jobs, causing spending to fall further. Consumers have so far proved remarkably resilient in the face of higher rates and rising prices. Still, there are signs that their sturdiness is starting to crack. Retail sales have dropped for 2 months in a row. The Fed's so-called Beige Book, a collection of anecdotal reports from businesses around the country, shows that retailers are increasingly seeing consumers resist higher prices. Credit card debt is also rising, evidence that Americans are having to borrow more to maintain their spending levels, a trend that probably isn't sustainable. More than half the economists surveyed by the National Association for Business Economics say the likelihood of a recession this year is above 50%. What are some signs that a recession may have begun? The clearest signal would be a steady rise in job losses and a surge in unemployment. Claudia Sahm, an economist and former Fed staff member, has noted that since World War II, an increase in the unemployment rate of a half percentage point over several months has always signaled a recession has begun. Many economists monitor the number of people who seek unemployment benefits each week, a gauge that indicates whether layoffs are worsening. Weekly applications for jobless aid actually dropped last week to a historically low 190,000. Employers continue to add many jobs, causing the unemployment rate to fall in December to 3.5%, a half-century low, from 3.7%. Any other signals to watch for? Economists monitor changes in the interest payments or yields on different bonds for a recession signal known as an inverted yield curve. This occurs when the yield on the 10-year Treasury falls below the yield on a short-term Treasury, such as the 3-month T-bill. That is unusual. Normally, longer-term bonds pay investors a richer yield in exchange for tying up their money for a longer period. Inverted yield curves generally mean that investors foresee a recession that will compel the Fed to slash rates. Inverted curves often predate recessions. Still, it can take 18 to 24 months for a downturn to arrive after the yield curve inverts. Ever since July, the yield on the 2-year Treasury note has exceeded the 10-year yield, suggesting that markets expect a recession soon. And the 3-month yield has also risen far above the 10-year, an inversion that has an even better track record at predicting recessions. Who decides when a recession has started? Recessions are officially declared by the obscure-sounding National Bureau of Economic Research, a group of economists whose business cycle dating committee defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. The committee considers trends in hiring. It also assesses many other data points, including gauges of income, employment, inflation-adjusted spending, retail sales and factory output. It puts heavy weight on a measure of inflation-adjusted income that excludes government support payments like Social Security. Yet the NBR typically doesn't declare a recession until well after one has begun, sometimes for up to a year. Does high inflation typically lead to a recession? Not always. Inflation reached 4.7% in 2006, at that point the highest in 15 years, without causing a downturn. The 2008 to 2009 recession that followed was caused by the bursting of the housing bubble. But when it gets as high as it did last year, it reached a 40-year peak of 9.1% in June, a downturn becomes increasingly likely. That's for two reasons. First, the Fed will sharply raise borrowing costs when inflation gets that high. Higher rates then drag down the economy as consumers are less able to afford homes, cars and other major purchases. High inflation also distorts the economy on its own. Consumer spending, adjusted for inflation, weakens. And businesses grow uncertain about the future economic outlook. Many of them pull back on their expansion plans and stop hiring. This can lead to higher unemployment as some people choose to leave jobs and aren't replaced. What effects will a recession have on businesses? Businesses large and small face declines in sales and profits during a recession. They can also curb credit access, slow collections, and spur business bankruptcies. And while recessions can have disparate effects for different companies, some of the hardships are predictable based on the type and size of the business. For example, a small consulting firm might experience cash flow issues as clients delay payment on invoices, while a Fortune 500 corporation may be able to save money by cutting jobs and extracting better terms from suppliers. Understanding how an economic downturn may affect your company or business can help ensure it won't become one of the casualties of the next recession. Recession impact on small businesses. U.S. small businesses have impressive numbers in the aggregate. Defined expansively as those with fewer than 500 employees, they accounted for 43.5% of the U.S. GDP in 2014, though that was down from 48% in 1998. Those with fewer than 100 employees still accounted for 30% of U.S. wages and 35% of employment from 2012 through 2016. Those figures shouldn't obscure the fact that most small businesses are tiny. Nearly 40% had revenue below $100,000, and more than 70% generated sales below $500,000, according to Internal Revenue Service (IRS) statistics from 2013. Just 20% of the 29.6 million small businesses counted by the U.S. Census Bureau were employers. This lack of scale leaves the vast majority of small businesses with less of a financial cushion, market power, and leverage within their industry to weather the tough times a recession brings. Small businesses tend to fare worse than large ones in a recession because they're less able to withstand a drop in sales amid mounting economic uncertainty. Recession impact on large companies. Large companies aren't immune to recessions. In 2020, 244 sought bankruptcy protection, the most since 2009. Energy, retail and consumer services were the hardest hit sectors. 8. As the declines in revenue and profit show up on quarterly earnings reports, share prices may suffer deep declines, since bear markets often accompany a recession and may even precede it. If the profit slump is particularly steep, some companies may be forced to reduce or eliminate shareholder dividends. Large companies do, however, have more ways than small businesses to combat the declines in revenue and earnings in a recession. They may reduce hiring, impose a hiring freeze and suspend pay raises, resorting to layoffs to cut costs if all else fails. Companies may also cut capital spending and marketing, curtail research and development, and stop new product rollouts. Such cuts at large companies are likely to have ripple effects on their many employees and suppliers. Dangers of recession on businesses. Credit impairment and bankruptcy. One of the first effects recessions have on businesses is the tightening of credit conditions. Faced with a downturn of uncertain severity and duration, lenders turn more selective of the risks they are willing to underwrite. A recession may bloat a company's accounts receivable as liquidity issues impact consumers and businesses up and down the supply chain. Customers who owe the company money may be slower to make payments or fail to make them altogether. The company may, in turn, be forced to slow its own payments. Employee layoffs and benefit reductions. Businesses large and small may undertake layoffs to cut costs, especially if they need fewer workers to meet the reduced demand for their products and services. Productivity per employee may increase, but morale may suffer as workloads increase while pay gains slow or stop amid the risk of further layoffs. Wages are sticky, meaning workers are reluctant to accept cuts in pay even if layoffs are the likeliest alternative. In a particularly prolonged and deep recession, however, labor and management may negotiate the cost concessions required to save the company and preserve jobs, including wage and benefit reductions. Slumping sales. In a recession, nothing hurts a business quite so much as when the register stops ringing as often, or when orders slow to a trickle. During an economic contraction, aggregate demand declines, translating into a drop in sales for most businesses. Cyclical industries including manufacturing and energy tend to experience particularly sharp declines. Companies with high fixed costs like retailers and technology suppliers face a disproportionate hit to the bottom line as revenue declines. Manufacturers may face bloated inventories, forcing them to slow output until demand recovers. We have come to the end of today's video. What do you think is the way out of this mess? Share your thoughts with us in the comments section. Hit the subscribe button and tap the bell icon to get notifications whenever we post another mind-blowing video. Talking about mind-blowing videos, why don't you check out this video on more info about what caused the US breakdown? See you in the next video.